video going over the 3 financial statements and creating a model from scratch to just link all of them, just to see how things flow through these statements. So first, I think it's a good idea to just cover the statements and what are they. So here's this Excel file. I don't have anything in it. I named this sheet O for overview. So the main 3 statements, income statement, excuse my typing, income statement, balance sheet, cash flow statement, or statement of cash flows. Income statement is also called a statement of operations. So this shows revenues, costs, expenses, profits. Balance sheet shows, I just keep it simple, assets, liabilities, and equity. Then the cash flow statement shows changes. What's the best way I can show you? I used to say changes in cash. I'll just write cash inflows and outflows. So these are the 3 things that we'll work on. So let's scratch. Let me format this sheet. I have my assumptions at the top, and I'm just gonna make up some numbers to get us started. We'll do 3-year forecast. Let's see, baby blue. It's a good color. We do this one. So my assumptions, and then this would be year 0, I guess. Year 1, year 2, year 3. And in order to do the balance sheet forecasting, I kind of need a year 0. Well, in order to do a cash flow statement, I kind of need a year 0 just to make some historical balance sheet numbers. All right. So the first things first, we'll start with what kind of company this is going to be. So assume this is like a fruit cart company. So this company sells fruit from a cart on the corner of the street. This is what this is. They're selling fruit on the corner of the street. Very straightforward. So I'll start out by saying what number of states are they operating in? You know, this is a lucrative business. Could be a lucrative business. But let's assume they only operate in 1 state. 1 state. And let me do this and move this thing to the center. I'll move this to the left. All right. So they operate in 1 state. And then let's say carts per state. Let's say they have like 1,000 fruit carts per state. Okay. And then we'll go with average revenue per cart. RPC would be average revenue, or average, selling price per cart, revenue per cart, same difference. And we'll say that is, I don't know, $200. $200. Let's increase it. Let's say it grows by 2% each year. Whoa. I didn't mean to italicize that. Maybe more than 10%. Let's say that's 10%, maybe. Oh, should be times. That's the problem. Times 0.02. Okay, that's fair. That's 3%, but like 3%. We'll grow by 3%. And then we'll say revenue equals fruit. Revenue equals number of fruit carts times average revenue. Let me put it in caps. Revenue will equal the number of fruit carts times the average revenue per cart. Let's enter that. One main assumption, that's our revenue driver. Then we have cost of revenue. This will make sense in a second if you're new to income statements. SG&A. Let's see, depreciation and amortization, abbreviated amort, and taxes. So this will take care of our income statement. So all of these here will be percentages. The cost of revenue in this case, let's call it 50%. SG&A, let's make it 8. We'll leave depreciation and amortization blank for now. Then call it 21%. In fact, we'll handle that somewhere else. We need to do something special for that. So this will get us an income statement. And then we also need assumptions for our balance sheet. Let's say this is the income statement. And let's change the color here. And make this that. Okay. For the balance sheet, there's a couple things we'll need. Let's think about it. So, accounts receivable. This is money owed to the business. Inventory for sure. We selling fruit. Accounts payable, I guess, to net against receivables. And then deferred revenue. Maybe we made a fruit sale after the last business day of the month, so we got some deferred revenue. Last business day of the quarter, so we got some deferred revenue. So let's make these assumptions real quick. So it happens that 5%, 10%. Accounts payable should be less than accounts receivable, I hope. So 3%, and then maybe 2% of sales. All right, that would be the balance sheet. So now we have our assumptions clearly laid out, eloquently. So eloquently laid out. Let me group all of this. If you aren't familiar with grouping, you just grab all of them, go to data, and then hit group. So now I have a little drop down. I can close them down. I can bust them over. I can close them down. I can bust them over. Because we're going to have all these statements on the same page. So this collapsible stuff will come in handy. All right, now let's start on the income statement. Let's name this income statement. And then we'll do this, copy this format. And then we will say every income statement starts off with sales. And another name for sales is revenue. So, revenue, cost of sales, gross profit. This line can have something special called the border. And the gross profit would then just be revenue minus sales. We drag that over. And let's calculate revenue. So I said here revenue, the assumption is revenue is equal to the number of fruit carts times the average the number of carts times the average revenue per cart, or the average sales per cart. Same difference, I guess. So it'd be 1,000 times 200. Yeah. I think we use that as a proxy. Cost of sales would be 50% times revenue. Now we have that gross profit, also known as gross margin, also known as, that's all it's known as. Profit margin, gross profit, gross margin. Then after that, we have, let's make a space. Have gross profit here, and then we also have some expenses. For expenses, we have our operating expenses. These are expenses associated with the operations of the business. Depreciation, and how did I abbreviate that up top? Oh, I took it away. I would say abbreviation and amortization. All right, and then that's probably our only expenses for now. So then we have total expenses, and I could do the same trick down here as I did below. And the total expenses, let me copy that again for good reason. So now SG&A will be revenue times 5% number, and then depreciation will come back and fill that in later. But the total expenses are the sum of these two, and we could drag that across. So we're getting somewhere. We're getting to operating income. Operating income, yeah, operating income or earnings before taxes, because we don't have any debt expenses. We didn't assume any of that. So same difference here. So gross profit minus total expenses. This is this number here. And it's no longer revenue minus that, it's gross profit minus operating income. And gross profit was revenue minus cost of sales. If you did revenue minus this, that would be wrong for sure. So you have to do gross profit minus this number, which is $100,000 minus $10,000. If I have everything correct. And this is pretty low for SG&A. Let's assume we pay ourselves some money. This business pays itself. All right, so we increase that a bit. So operating income is this now. And then we don't have any interest expense and interest debt, so we can actually change this to say this is earnings before taxes also. Earnings before taxes, or pre-tax income, or I can keep this op income, I guess, if I want to. Below that, I'll just write taxes. I just write taxes, and then after taxes, of course, you get net income. And I'll probably just put EBT, earnings before taxes. So taxes is earnings before taxes times our tax rate, which 21%, because that's the going tax rate in the United States right now. And then net for net income, and we copy this formatting and throw it here. So EBT minus taxes, this amount: $66,000, $68,000, $70,000. So the business is booming. And we calculate some other stuff later. But for now, this is the income statement as you know it. This is our basic income statement. Let's group this. Let's name this 3-statement model. Well, let's name this model 3X. I think that name a little better than the lone one. Alright, so now what's next is balance sheet. We gotta start making things balance. Alright, so now we got the balance sheet. Balance sheets always start off with cash. Every balance sheet, no matter, starts off with cash. And this is universal. From my understanding, it's universal. Yeah, I'm not a CPA, but from everything I've seen, this is universal. So cash, and let's say we have some accounts receivable, and this is going to be the historical column. I need to make this up in order to calculate and link the cash flow statement properly, which I will show when we get there. So we'll have some accounts receivable. Let's say we have some inventory. What else was there? Okay. So this all will be current assets, short for CA. There's also current assets. And then we have some PP&E net of depreciation, and then we get our total assets. So our total assets will just equal current assets plus long-term assets, like PP&E. And so let's make up some numbers to begin with. So let's say $50K in cash, $8,000 in accounts receivable, $10K in inventory. So some of these. 68,000, and then for PP&E, we're only running. What are we running? 1,000 cards. 1,000 cards. 1,000 cards. It's a lot of cards. Let's say the cards are pretty cheap. We have $11,000. That's how we will roll for now. And then the liabilities starts out with accounts payable. Accounts payable, I'm gonna abbreviate A/P, similar to accounts receivable. Then after that, I think we have some deferred revenue. And then after that, we have current. Well, these are current liabilities, but since there's no long-term liabilities, I'm just gonna put total liabilities here. Now, current assets current assets and current liabilities. Those are things that change within a year. So in a year's time, your current assets should pay off your current liabilities. Is what they told me. Now, next, finish the balance sheet. So let's say we got some equity capital, money that was invested, belongs to the owners. Then we have some retained earnings as well. This is money that the company has kept over time. Imagine it's like a savings account where every time you get paid, you include money into your savings and it accumulates over time. So we'll show how that works. So for accounts payable though, let's get some numbers here. So let's say, so we got this time out to 79. Gotta make up some stuff to get this stuff to match. So let's say 6,000, 3,000. That should give us 9,000. Then we got $70,000 to work with here, so we can split this up 20,000 and 50,000. All right. So now we have equity. Equity. Sign, not sign. Equity. Sum, not sign. All right. So next is total liabilities plus equity, because the balance sheet formula is assets must equal, no matter what day of the week it is, assets must equal liabilities. So total assets must equal the sum of TL plus equity. TL plus equity here is 79. And just in case you don't believe that, this number should equal this number. And we can say put a B for balance or put an N for not balance. And it is B. And the rest are B as well because there's no numbers in here. But to show you the formula is working, if I put that, why is that still balancing? Oh, yeah, easy, it's no. So, since I'm here now, we can actually start filling in the formula's working by the way, but since I'm here now, we can start filling in the balance sheet. So accounts receivable, I said, we're gonna take this as a percent of sales. It's simple. You can actually use days receivable as well. Days receivable, but not to confuse anyone, we will keep it simple. Inventory, we should probably do as a percent of cost of sales, maybe. And assets, we have those now. PP&E should be nothing here. That's the example. We'll fill that in a second. Accounts payable, I guess it should be days payable, probably outstanding, that you could use as a proxy. But since we only have one historical piece, I would make it up and do percent of sales. And then deferred revenue also. Now again, if you have more quarters than to forecast accounts receivable, you can use receivables, days receivables, and days payable to help with the forecasting proxy. So now that's what we got. Let's assume equity capital stays the same. And retained earnings would be retained earnings plus, as I told you, net income flows directly into retained earnings on the balance sheet. So it'd be the prior amount plus the new that's coming in. And then total liabilities, bring this over. And none of these should balance because we're missing two things, PP&E and cash. We're missing two things, PP&E and cash. So in order to get the PP&E piece, I need something called a depreciation schedule. Let me copy this, format this. All right. So for CapEx, which we have, so for CapEx, let's say we have carts. We need this. This is vital. And then we have, let's say we have some software. Here we could put our useful life. And let's say our useful life is 2 years. Both, I guess. Year 2, year 3. All right. And so let's say for cards, we spend about 8,500. 8,500 and then 0 for the rest of the 2 years. And then for software, let's say we spent 2,500 and then we spent 3,800 and then we spent 0. So the net or total capex sum of these two, 11,000 and 3,800. Then we have depreciation. So these are the physical things we're buying, or the, in terms of software, the intangible things we're buying. Flow into capex though, and then depreciation is how we're going to depreciate them. So we have cards, and then we still have software. So to calculate the depreciation amount, we'll just do 85 like this divided by 2, and then we could drag that over. And let's say, since we're going to drag this over to 3, let's switch it up. Let's say these things last 3 years. And then for software, let's do 12. Well, the answer will be 1250 for software, because it's going to be 2,500. Actually, it won't. It'll be slightly different. 833, but if it was 2, it should be 1250. Just right in half, but we switched it. So 833, and let's lock it. And we drag this over here though. On this one, we need to add in this new amount that we purchased and divide it by the old. Yeah, that's right. And then there's nothing for the last piece. All right. I think this makes sense. And then we have total depreciation. Sum those. That's an accident. Wrong button. All right, sum those. So now we have everything. So here, for our depreciation, I can lump in depreciation, drag it over, and then for PP&E, I have to add it to the last one. So we had 11,000 plus this number, well, plus this, and it's going to be, it's PP&E net. So plus this capex here minus the depreciation amount. This is how that should go. And then for the next period, it's the same. Should be the same. I think that's right. We'll know if it's not right if our cash flow statement doesn't balance. I mean, if our balance sheet doesn't balance, then we will troubleshoot. But next we have the cash flow statement. So the cash flow statements, all of them, start off with net income. No net income for this time period, but net income flows into the top line of the cash flow statement as well. And then you have D&A, which is depreciation and amortization, which now we can grab from the income statement because we know that. Then what's next is the changes in net working capital. So next would be the changes, AR, changes in inventory, changes in accounts payable. Let me abbreviate it. Changes in deferred rev, deferred R, and then we'll get cash flow from operations. So first, we need to get the change in accounts receivable. So in order, sorry, excuse me. So in order to get the changes in accounts receivable, we have to say, okay, how much is owed to us last period minus how much is owed to us this period. So it's 2,000. And then for inventory, it's similar. We have to go to, it's similar, but it starts with this year, right? How much we have in inventory minus the change. That way. And then what do we have next? What do we have next? Actually, this should be opposite. It's the same, like this. Oh, are these moving the same? Oh, they are. Tricky assumptions that we made. But anyway, that's that. And then next we have accounts payable. So accounts payable is what we owe. We have to pay someone some money for our accounts payable. And so in order to figure out how much we have to pay, we do it this way. We go to accounts payable. This time, how much we owe this time minus how much we owe last time. And then changes in deferred revenue. Give you a second to think about it. But the changes in deferred revenue are eerie similar. Are eerie similar. All right. So we have the changes in all these things. And then we can sum these. That should be right. And then next we have CapEx. And then cash flow from investing. Maybe I should write these out. Cash flows from operations. Cash flows from investing activities. And then we'll get to the next step. But CapEx is what we did down here. So we know how much we had. And then cash flows from investing, we only had that. So we just sum that here. And let's group this before I forget. After cash flows from investing, you have cash flows from financing. Now we didn't issue any debt. We didn't issue any equity. We didn't do any stock buybacks. We didn't pay any dividends. But those are all things that can be down here. So right now we didn't do any financing activities this go around. So there's zero no cash flow from investing. But now we need to calculate the net cash increase. Whoa, let me do with cap. Net cash increase, which is going to be cash flow from operations plus cash flow from investing activities plus cash flow from financing. And free cash flow is cash flow from operations minus CapEx, but it's actually this one. Oh, and sorry, this should be a negative because it's a cash outflow. But let me just change this formula because it's easier. It shouldn't be plus, it should be minus, all of these things. Like this. And these two should be the same, which is how I call my error, because there's nothing from cash flow from financing, and the only thing in CapEx is, and the only thing in investing activities is CapEx. So those two should be the same. All right, now back to the balance sheet. So we notice the balance sheet still is not balanced. It has B, N. N is for not balanced. If we look at the formula we wrote, that's because we're missing cash. So if we did everything right, this would probably tie out. So it's cash from the last period plus the cash increase. And then we drag this over And what do you know? We have a balancing cash flow statement. Let me edit this. Home conditional formatting equal to B. Make it green. I have a shortcut for last name. All right, so everything balances. So let me make this. Let me group it. Data group. And then let me come back to income statement to calculate a few ratios. So first thing I want to see is revenue year over year, which we know because we made the assumptions. Gross margin percent, op margin. Well, we don't really have a EBT margin. Calculate revenue growth is new divided by old minus 1. This is a percent, so it's 3%. How did I know that? Because I made the assumption. Gross profit margin is the gross profit divided by gross revenue. 50%. How did we know that? Oh, because we said the cost percent. So if we actually change this from 50% to 60%, what do you think the gross margin would be? Remember, I don't know why that keeps happening. Gross profit equals rev minus cost. Right now, gross is equal to 100% minus 50%. If I change 50 to 60, what should the gross margin be? That's the question. So if it's 100% minus 60% now, then that means this should drop 40%, and this should increase to increase 10%. And what this means so far is that this 50% margin here means that after we pay for our cost of sales, the cost for us to sell this fruit, we keep 50 cents of every dollar. We have 50 cents on the dollar. So if I change this to 60, as you can see, this changed. So let's check everything out. So I changed it back. So 66,504. This net income will adjust retained earnings by how much? It's the question. We will see. So changing this net income, it'll change retained earnings amount, and it'll change the net income and the cash flow from operations amount. It'll even change the net cash amount. So let me hard code this so we can just see. Let me paste this as values over here. I'm gonna paste this values. I'm gonna take this. I'm gonna paste this values. I will take this, and I guess I wrote something there. Let me move this. Just want to reference it again. And then I will take this and I will paste it as value. And I don't dance unless I hear music. So what was I doing? So let's change this to 60% and let's see how everything happens. So look, we changed the cost of revenue. We didn't change revenue, so revenue is still the same. But our cost of sales now have increased by 21,218. Or changing these to 20%. That's the change in between these two. We increased it 10%, but the change between the old one and the new one is 20%. What else changed? Gross profit decreased. How much is gross profit decreased by? 21,218. And the cost increased by 21,218. So there's a relationship that says if my costs go up by 21,218, my gross profit is going down by 21,000. SG&A stayed the same because we changed nothing. Depreciation and amortization stayed the same because we changed nothing. But look, total expenses stayed the same also. EBT, however, is lower. Take a guess on how much is it lower by? 21,218. What do you know? So one simple increase in cost of sales, holding everything else constant, can decrease your earnings before taxes. Our tax rate, look at this, our tax rate decreased by how much? 4456, because our tax rate is 21% of this number. So if this number is lower by 21,000, our taxes will be lower by 21,000. Not 21,000, it will be lower by X percent, which we've seen here. And our net income is down. How much is our net income down by? Is it going to be 21,218 or will it be a different number? This is not a trick question. Okay, had enough time to think about it. It's less. It's down by less than 21,218. The question is why? Sales decreased. Sales went up by 21,000. Gross profit went down by 21,000. Earnings before taxes went down by 21,000. Taxes only went down by almost 4,500. So I wonder what the difference between the earnings before taxes and the taxes. I wonder what the difference between those two will get us. Said differently, 4456 or minus 21,218 plus 4456. What would that get us? 21,218 plus 4456. Should have been minus. This would have been a negative. Which gives us 16,726. So you see that everything will decrease by 21,218. The taxes decrease by the tax percent times EBT, which is less than 21,218, of course. And so net income will decrease by the net of EBT and taxes. But you can almost guarantee that. You can always guarantee that if you increase the cost of sales and hold everything else constant, the net income will be lower. This is not a game. This is not a drill. This is the truth. Let's go down and keep looking. So what happened to cash on the balance sheet? It went down. How much did it go down by? 18,884. Remember, this cash comes from the cash flow statement. So in order for us to understand this this change, then we have to go back and take a look. And look what else changed. Equity changed as well. How much did equity change by? 16,762. And how much did retained earnings change by? I did that right. 66,504. Oh, I did the wrong one. I'm like, hold on. 16,762. So retained earnings, remember, what flows into retained earnings? Net income. Net income went down. Net income went down by 16,762. So retained earnings, meaning think of that as like your savings account that you're trying to accumulate as much cash as possible over the history of this account. This went down because net income went down. So this went down 1762. So however much net income goes down by, we should see that hit to retain earnings as well. But remember, cash. Let's go back to cash. So everything else is the same on the balance sheet, FYI, as you can see. Except total assets is different, but I think you kind of get it now. Why is total assets different? And how much is it different by? 16,762. Let's just drag this up. Inventory change. Wait a second, why did inventory change? Oh, because we calculate inventory as a percent of our cost of sales. Cost of sales. So it was originally 10% of 106,090. So our assets went up slightly by 2,122. And our current assets went down by a net of 16,762, which is the same our net income change, 16,762, which is the which is the net of EBT and how much we pay out in taxes. So here's that 16,762, and then we have a zero PP&E. We didn't change that, and so total assets change with this scenario by 16,762. So if you just understand by changing one thing, cost of sales, we see how all of this is changing on the balance sheet. So now let's go down to statement of cash flows. Off rip, you notice net income is down by $16,762. That shouldn't be a surprise. Let me just drag this down. Cash flow from operations is different by $18,884 because there's a $2,122 difference in, guess what, inventories. So this is how all these statements tie out because of these linkages. So you see the 16,762 that went down in net income. It had a change to inventory, and so the sum of those, or the sum of those was the $18,884. Now nothing else changed, but something else after the fact changed. So the net cash increase, it went down by $18,884. But we knew that already because we seen how much cash changed by, and we know cash on the balance sheet is the old period's cash plus the cash increase from the cash flow statement. So again, this analysis shows us how everything flows through all of these statements. That was just one change we made to the cost of revenue. We increased it by 10%, and it effectively had a this way to calculate. We changing cost of sales by increasing it by 10%, had a 25% impact to net income, and it had a 8% impact to cash. What else is there? I don't want to talk about anything else. That's pretty much it. So we did all this from scratch. Everything ties out, which is important. So that's good. And we have a 3-statement model now, all on one single page. So if you collapsed, if I just said, hey, I don't want to see this, don't want to see this, what did I not do one for the balance sheet? So data, group, close it, and close it. So this is how it'll look there. So if somebody only wants to check out the assumptions, they can just click this one and say, hey, okay, here's the assumptions. They want to check out the income statement only, they say, hey, here's the income statement. And we did the experiment now, so I can delete all these. If they only want to repeat the balance sheet, they can do that. And only the cash flow statement, they can do that also. And the depreciation schedule, they can do that also. So we have all 3 of these models for all these years on one single page. Tighten it. And you can also see all of them at once. If you want to do an experiment like we just did. Like even changing, what if we change the useful life? I'd have made a video too long, probably, but you can experiment with this and just change certain variables and hold everything else constant to see how things flow through the statement. So thanks for watching. Hopefully this was insightful. Hopefully you learned something. If not, my bad. I tried. Have a good one.